Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to the Cut to the Chase podcast. Now, markets received some good news after what felt like a number of weeks of downward pressure on risk assets, as several media outlets reported that Russia was withdrawing some military units from the Ukraine border, raising expectations that the worst of the crisis could be over. The Nasdaq and S&P 500 led the charge higher in risky assets. WTI all, of course, dropped back towards $92 given fears of supply disruptions were one key link between the geopolitical crisis and financial markets. Now, we'd caution, of course, that it may be too early to conclude the crisis is indeed over. NATO Chief Stoltenberg said that there was little sign of de-escalation and the US reiterated the threat of sanctions in the event of an invasion. However, for today at least, Asian equity markets are likely to pick up some of the optimism from the US close. Now, that's on equity markets, of course, but the modest easing of geopolitical tensions also meant US government bond yields moved higher, with the 10-year Treasury yield jumping back above 2% to about 2.04% at this time. This came, of course, as safe haven demand eased, leaving bond markets to go back to focusing on just how far the Fed could raise interest rates this year. Now, a few interesting points I wanted to talk about on this front. First, of course, on technical charts, the 10-year bond yield appears to have clearly broken above key resistance at 1.98%. On its own, this means bond yields could now be poised to rise higher if demand for safe havens remains capped. Guidance from Fed policymakers, of course, are the other crucial factor. We already discussed earlier this week how several Fed policymakers are set to make public comments later this week, and those we think take on new importance in light of this move. Now, a lot of the market narrative has focused not just on rising bond yields, but also on a flattening yield curve, or in plainer English, a narrowing of the gap between the 10-year bond yield and the 2-year bond yield. This is important because an inversion, or a negative gap between the two, has historically signaled a recession is ahead. Now, this, of course, might be a good time to point out that this gap today does remain firmly positive, and rising 10-year bond yields, if anything, delays a little bit the point at which this gap eventually turns negative. This inversion is really the only signal we'd worry about, as a narrowing gap or a falling yield curve can still be quite consistent with risky assets and corporate bond markets continuing to make good gains. Now, rising Fed rates are also likely to raise some questions over the impact on emerging market bonds by the risk of capital outflows. Early comments suggest this is likely to be a focus at this week's G20 financial ministers and central bankers meeting. These concerns notwithstanding, of course, ex-China Asia local currency bond inflows actually jumped to a 5-month high in January. In our view, the lack of a surging US dollar remains the key, of course, to sustaining inflows for EM bonds and EM assets more broadly, in our view. So overall, what this means is that while we'd keep a firm eye on just how US government bond yields evolve and how the US yield curve evolves, we would not worry excessively from an equity market point of view as long as the rise in bond yields is accompanying a broader improvement in risk appetite and the yield curve does not invert completely. Those are the two sort of markers we think are really important from a longer term point of view. So we leave it there. Again, if you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening, and we wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.